10 from the bell to Christina now for a look at some of the chips that are trading very poorly today, Christina.
Yeah, and that's why I got to start with Wolfspeed because it's facing its worst trading day in history. Shares are down 52% amid ongoing financial struggles. Despite receiving $192 million in tax credits, the company faces debt refinancing challenges, negative margins, factory closures, and delayed profitability. It's also still seeking government support while only projecting cash flow positivity by fiscal year 2027. You've got the regulars you've been talking about, Scott. Inflation, tariff concerns, upcoming chip export restrictions, the diffusion rules. They're all weighing on the chip sector with the SMH and SOX ETF down about 3% or so, lower than actually NVIDIA at this point. Custom chip maker and AI darling as well, Broadcom, on pace for its fifth negative week in six. It's actually its worst quarter ever. The stock down about 28% year to date. And then lastly, I'll end with Intel. Those shares are down nearly about 4% as investors really digested Thursday's announcement about a board shakeup. The chip giant revealed that 3 directors are heading for the exit as the company's looking to bring in fresh blood with expertise that better matches where they're trying to go strategically. Shares down about 4%, Scott.
All right, Christina, thanks so much. Christina Partsinevelos. Still ahead, gold, a bright spot in today's down tape. Been a bright spot for a while now, above $3,000 an ounce. We'll have more on that in the market zone next. now the closing bell market zone. CNBC senior markets commentator Mike Santoli here to break down these crucial moments of the trading day. Plus, Pippa Stevens on the rare bright spot in today's sell-off. Financials also hit hard today. Leslie Picker's going to join us with those details. Mike, just give me your thoughts on what's happening here.
Yeah, I mean, obviously some form of a retest of that low from a couple of weeks ago. We've been talking about it for a while now, how, you had this kind of credible chance that was going to be it, 10% down. The economy hangs in there. People are able to look forward to some resolution on tariffs. It just proved to be a very unimpressive, unassertive response. Now, that being said, it's not desperate get me out panic time in the action. The VIX is under 22. The last time we hit this level, 5,500 and change on the downside just a couple of weeks ago, we were above that. So what you sometimes are looking for in this testing process is lower selling intensity, fewer stocks making new lows, even as we get toward these levels. It's tempting to try to say maybe the sentiment surveys and just the gloom out there is overdone relative to the damage that's been inflicted on the stock market or the economy. I think it's time to ask that question. The equal-weighted S&P is only down 1.5%. That said, do we still think we're going to get clarity next week? Do we think we're going to clear ourselves of this overhang, have prices reset enough that the bar is low for earnings? I think that's what we're going to be fighting with for a while here.
Do you take anything out of the CoreWeave IPO, which is modestly red?
One, I say it's good when investors are discerning about the biggest deal in a while that's trying to harness itself to the most obvious, huge, big picture theme in the market for the last 2 years. I do think that it shows you that we're just not going to give the benefit of the doubt to pure hardware-based, kind of all or nothing type companies that are trying to play this trend. So even though it shows you that maybe we're at a moment where these companies are not going to be rewarded for just investing a ton in this space, I do like the fact that you've shown the skepticism that NVIDIA's been dead money for 9 months. I don't think tech leadership is going to sort of pick itself up and resume at this point. But I do think that, it shows you that we're willing to, to sort of use some skepticism when it comes to the big names.
6 months ago, that chart would probably look a lot different, don't you think? Yeah. Pippa, tell us, speaking of charts, what is a bright spot in this market?
Scott, well, gold, because this trade just keeps on shining, with gold hitting its 17th record this year as trade tensions, elevated growth uncertainty, and inflation fears prompt a flight to safe haven assets. Bank of America noting this week saw $3.2 billion flow into gold, including a one-day record of $2.2 billion. The firm also upping its gold target to $3,500 per ounce. Gold is now pacing for its best quarter since 1986, which is boosting the miners, with the GDX adding 15% in the last month. Citi saying today that it's a, quote, once-in-40-year gift for gold producers as margins hit multi-decade highs. The firm forecasts gold remaining high or going even higher this quarter and next, before moving to a more conservative base case. Now, also quickly, check out silver, because it did dip a bit today, but it did hit its highest level since 2012 earlier today. Scott?
All right, Pippa, thank you. That's Pippa Stevens. Leslie Picker, tell us about the financials.
Yeah, you got fintech firms like PayPal, insurers like MetLife and Prudential, and alternative asset managers like Blackstone and Apollo. They're really leading the sector to the downside today, but it's pretty broad-based here. Growth concerns once again taking aim at financials, which are adversely impacted by any drop in consumer sentiment and the risk of inflation intensifying. We're also exactly 2 weeks out, Scott, from the start of first quarter bank earnings, which will provide a fresh read on how much the macro and policy noise is impacting everything from investment banking to loan demand. Still, Mike Mayo of Wells Fargo out with a new note today calling for an industry-wide improvement thanks to better profitability dynamics for loan making, decent credit quality, and likely solid trading at larger banks, especially given the volatility in Q1. He also says he expects an inflection from deregulation to be the biggest in 3 decades, Scott.
All right, Leslie, thank you. That's Leslie Picker. Back to Mike. 90 seconds or so left. April 2nd, clearing event. We'll see. Jobs report.
Yes.
Got a big week.
The jobs report is pretty big. I mean, obviously, the bond market's telling you full-on growth scare at this point. There's this fear out there. I know you had the stagflation conversation a couple times. The point is, you're being disappointed on both fronts. It's not necessarily like we have massive unemployment and raging inflation. But it seems like the risks are just too uncomfortable that's going to hem in the Fed. If the job market looks like it's hanging in there and unemployment is contained, at least you can maybe cool that off on the growth side just a little bit. I do think it's very, very foggy in terms of looking at what the consumer outlook is for here. I hear what Ed Yardeni is saying about dry powder building up because the incomes have been outpacing spending for a quarter. But it's also hard to ignore what the companies have been saying.
That's right.
And the companies are basically trying to look through and say, we just don't see a buildup of demand. There's a lot of caution out there along with the consumer. Still, the good news is good news. Economy versus stock market. At some point, we might notice that bond yields have come in, and if the economy is going to remain, reasonably resilient, that's a net positive.
All right. Have a good weekend, Mike. All of you as well. Of course, we're going to go out decidedly red here to end the week. We'll end the quarter next week, and then, of course, we'll find out on April 2nd what happens in the next tariff stage, if anything. I'll see you then. Morgan picks it up in OT.
That's the end of regulation. Riverdance 30 ringing the closing bell at the New York Stock Exchange. Amber International doing the honors at the NASDAQ. Hard truths from hard data today as a hotter inflation print coupled with weak consumer sentiment sent markets tumbling. The S&P finishing down about 2%, pushing the major averages deep into the red for the week to reverse those gains. That's the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan. John Fort is off today. We've got a big show coming your way. Former Fed economist Claudia Sahm will join us with her reaction to today's potentially concerning inflation print and how it could impact the Fed's next moves. Plus, T. Rowe Price tech portfolio manager Tony Wong breaks down the pain today in tech and what CoreWeave's IPO says about demand for AI stocks, with that stock basically finishing flat today. And why one technician says we might be near an intermediate term low in the market and why he's sticking with a bullish year-end forecast. We're going to be checking into the technicals here, but we begin with this market sell-off more broadly as the rebound attempt this week has failed. Let's bring in Unlimited CEO and CIO Bob Elliott and Richard Bernstein Advisors CEO Richard Bernstein. It's great to have you both here on what is another down day and down week for the major averages. Bob, I'm going to kick this off with you because one of the conversations we've been having is the idea that so-called smart money or hedge funds and institutional investors are really selling here, de-risking ahead of the tariff April 2nd deadline next week and coming into quarter end and basically sitting on dry powder. Is that what you're seeing in the data?
Yeah, that's certainly right that what you see is hedge fund managers are really pulling back. I think the thing that's interesting is they came into the last couple of weeks with low conviction, trying to get a feel as to what direction policy would go. And right now what we're seeing is we're starting to see a shift towards a more bearish sentiment, looking at de-risking their equity portfolios, buying bonds, and most importantly, they're as long gold as they've been in more than a decade. So apparently they've been listening to us talk on Friday afternoons.
Yes, and I'm going to get into that too because we did have another record high for gold. You've been bullish on it for quite a while. But first, Richard, I want to get your thoughts on the market here and the fact that we did breach some technical levels in the S&P as well as the NASDAQ this week, and certainly pretty weak trading session here with a number of factors, including inflation, including, tariff uncertainty, et cetera, factoring in here.
Right. Well, Morgan, it used to be that the word that we saw unprecedented use of was unprecedented. Now the word that we're seeing unprecedented use of is uncertainty. So I think, the market is very simply, I think everybody knows there's uncertainty. Right. And we could make a list of all the different sources of that uncertainty. And what's happening is a very normal process where the market is being revalued for a higher risk premium for U.S. assets, right? The more what businesses need, what investors need is clarity and consistency. And we've been lacking both clarity and consistency. So when you don't have clarity and consistency, you want a higher risk premium. It's like a junk bond versus a treasury. You want a higher risk premium. And so that's what we're seeing. So we've seen about 4 or 5 multiple points knocked off the S&P so far this year, despite reasonably healthy earnings. And that's everybody reassessing for the uncertainty. Now, you couple that, just one more thing here, you couple that with the notion that we entered the year with investors being historically confident about the future. If you look at, Merrill Lynch showed that the private client beta was up to 1.7. Michael Hartnett and Merrill pointed that out. I mean, that's tremendous amount of risk in a portfolio. So people, what you did was you entered the year with people being incredibly historically confident, and they got socked in the jaw by all this uncertainty.
I mean, 3-month chart, if I look here at the NASDAQ, Bob, and we're down 12% here. For the S&P, similar situation, we're down 6%. We know it's actually much starker than that if we look back at, just a month and a half. Dow, similar situation. Meantime, Treasury yields have actually fallen. 10-year back below 4.3%. We've seen a rally in Treasuries. Do you like that better than stocks right now?
Yeah, I think when we're looking at what's being priced in right now, we still have just unwound the euphoria that Richard was just talking about post-election. Right, but what we haven't done is we haven't meaningfully priced in a slowing of growth that's likely to occur. If you just think about where are we in the S&P 500 right now, we're not that much lower than where we were prior to the election. At the same time, what we've seen is an administration that's delivering a set of policies that are pretty negative on growth, whether it's restricting immigration, the tariff policies, DOGE cuts, employment cuts, et cetera. All of that lines up with a much weaker growth picture ahead, and those pro-growth hopes have been dashed, and they're now meeting essentially a wrecking ball of policy that is going to slow growth ahead at a time when the Fed is now being handcuffed. And today's data was such a good example of how challenging it's going to be for the Fed to get ahead of this. When you have core PCE coming in at 0.4, when it continues to be up close to 3%, the Fed cannot move until there's a meaningful weakening of growth, and they haven't seen it yet in the data, and so they're not going to get ahead of this the way that they had hoped to before.
There's no Trump put in the market, no Fed put, at least for now, in the market. Richard, I mean, is this a buying opportunity here given the downdraft we've seen, or do you need to see more certainty? And if so, how does that certainty manifest to feel more constructive on stocks here?
So Morgan, my answer to your question is it depends on what you want to buy. I think that everybody knows the world is changing except for technology investors. Technology investors, for some reason, think that we're in the same world we were in a year ago or a year and a half ago. And clearly we're not. So I think if you're looking at an S&P index fund, I think if you're looking at the Mag 7, I think if you're looking at the tech sector, no, it's not a buying opportunity. I think if you're in companies that have more stable cash flows, I think if you're looking at dividends, I think if you're looking at quality around the world, not just the United States, sure, I think it is a buying opportunity.
Okay. Richard and Bob, thanks for kicking off the hour with me.
Thank you.
Well, let's turn now, speaking of tech stocks, a brand new one, CoreWeave, closing exactly flat in its first day of trading, sliding just a bit here in overtime. The name is seen as a bellwether for the broader IPO market and, of course, for this AI demand and AI trade. Christina Partsinevelos joins us with the latest. Hi, Christina.
Hi, Morgan. Well, it's pretty impressive, 40 flat, which is still above the $39 opening price, but below initial expectations. CoreWeave, for those that don't know, they rent out AI hardware, mostly GPUs, so customers really don't have to deal with that hardware hassle, especially all the software. And the CEO telling CNBC earlier today that they had to right-size the transaction based on buyer interest. What is that telling us? It's a tough market out there, and they needed to adapt. This was, like you pointed out, Morgan, the first big tech IPO in 4 years, and really seen as a litmus test for appetite in the market, not only for IPOs as a whole, but also a pure AI infrastructure play. The company, CoreWeave, went from making $16 million in 2022 to almost $2 billion in revenues just last year, which is impressive growth, although not profitable, with looming concerns we talked about, debt. But keep in mind, this is a growth startup formed back in 2017 as a crypto miner, not too long ago. Earlier, maybe just a few hours ago, I caught up with CoreWeave's CEO, and he reiterated that CoreWeave's debt appears more manageable because it's systematically paid down through reliable revenue streams, like Microsoft contracts, for example, which contributes 2/3 of their revenue. The assets, secondly, such as GPUs, actually retain more value than everybody keeps talking about, this decelerating depreciation or accelerating depreciation schedule. And then lastly, new major partners like OpenAI are really a vote of confidence in the company's long-term viability, aka they wouldn't do business with CoreWeave had they not done their due diligence, and they're fully aware of all of their debt matters. So like you said, this IPO really does matter beyond just CoreWeave as a name, even though I'm sure everyone's really excited here. It's a temperature check, though, for pure AI infrastructure companies, and more broadly shows us whether there's still appetite for tech IPOs, well, markets remain pretty unpredictable, as we can see by today.
I mean, on a day where the NASDAQ finished down 2.6%, I think the fact that this stock finished basically flat with its IPO price, which, mind you, I realize was lower than the initial range, perhaps speaks somewhat positively to appetite here. I mean, is that the takeaway here? And I guess just as importantly now, given you just gave us some context around, chip depreciation and leverage on the balance sheet, is diversification to other customers really going to matter even more?
Oh, yeah, 100% it's going to matter no matter what, just going forward, because if one company like Microsoft decides in 4 years, the average life of a contract with CoreWeave, if they decide, hey, we're not going to keep building out, then that's a lot of money gone out the window. But to your point here, everyone's quite optimistic about the growth of this company. Magnetar Capital was on Squawk on the Street earlier today, and they're a big institutional investor of CoreWeave, and they said that this is the most growth they've ever seen in their 20 years working in this space. And so yes, they are giving out loans to this company, so they're highly connected and reliant on CoreWeave doing well, but it does speak, I guess, volumes to the growth of the company. It's just a matter of the debt level and all of the building, the data center infrastructure, and how valuable that is, 5-10 years from now, when supposedly everything is going to the compute is going to get more narrower and narrower and need less hardware. But we'll see about that.
We'll have to see where we're at with this name in 5 years, given some of those contracts. All right, Christina Parson-Evelis, great reporting today. Thank you.
Thank you, Morgan.
Speaking of tech, it's been a brutal quarter for the sector. Magnificent Seven stocks are down 14% so far this year. So what does that mean for tech returns moving forward? Well, let's ask Mike Santoli. Mike.
Yes, Morgan, and I will ask history as tabulated here by Ned Davis Research. This is during years when in the first quarter, the S&P technology sector has underperformed the broad index by at least 4 percentage points. Right now, we're about to close the first quarter, and S&P Tech is down 6 or 7 percentage points more than the S&P. So obviously, we're going to qualify this year. So here's the end of the first quarter. This is the blended average of all of those prior years when you've had such a rough start to the year for tech. And what you see, obviously, is more relative weakness. Now, this is the tech sector relative to the S&P. So it doesn't mean that on average you've had negative returns for the rest of the year, but it suggests that technology itself has not historically sort of picked itself up and sort of led the market again after a rough first quarter. So just one of those guidelines out there to suggest that maybe this rotation we're seeing this year. And by the way, growth into value has been a big theme, even though it seems like the market in general has had a rough time. Value stocks, equal-weighted S&P, as well as dividend stocks have actually held up reasonably well, mostly hold their value so far this year.
That's exactly where I was going to with my question, Mike. And that was, if tech doesn't typically, historically hold up, what does? Does it speak to a broader rotation in the market?
It probably suggests a broader rotation. I think the tricky part is that tech is so big within the index, and the other stuff that's had a hard time working, communication services has been fine. Financials have kind of hung in there. But the question right now is, if you just look at where the outperformance has been, it's been like precious metals, utilities, little bit in financials. Energy's had a decent run. Collectively, they don't really amount to a huge chunk of the index. So that's the reason I think that the overall index flows have struggled, and the fact that it's tough to see how you really have a big up year if, in fact, tech and related stocks are on the sidelines.
Okay, Mike Santoli, we'll see you later this hour with the S&P and NASDAQ, both on pace for their worst month since September of 2022, and both on pace for their worst start of the year since 2020. Well, meantime, weak data today adding pressure to this market and piling onto this theme of uncertainty. So consumer sentiment worsened as inflation fears grew, and the Fed's key inflation measure came in higher than expected this morning, PCE. Joining us now is Claudia Sahm. She is the chief economist at New Century Advisors and a former economist at the Federal Reserve. And Claudia, it's always great to have you on. So definitely want to get your takeaway from the data, the disappointing data we saw today, especially in light of all the debates we've been having around soft versus hard data.
Yeah, this is tough. On the inflation data, it was yet another month that underscored a theme that frankly has been with us for several months, if not the past year, grindingly slow and uneven progress towards 2%. Right. And I think then we also remember we are in the early innings of what could be inflation picking back up. today's inflation data might count as a good day when we get later this year. So I think that's what's also really disappointing is before a lot of these policy impacts are in place, we have inflation looking pretty weak. Inflation picked up, looks, strong. The consumer spending did not have the pop in February we were hoping for. So it's like you have a setup that isn't good. And then I think it's very rightly so that consumers look at this, business look at this, and you ask them, what do you expect for the rest of this year? And you do not get very positive answers back.
I mean, we got the FOMC meeting last week, and the big thing that came out of that essentially was the SEP and the dot plot and the economic forecasts. And as our own Steve Leisman has pointed out, what you saw if you read through some of the decisions that went into some of those forecasts is a tilt towards perhaps rising risks of stagflation. Are you in that camp?
Absolutely. That jumped out at me first thing in those summary projections. Normally when you do a forecast, and each Fed official gives us their baseline forecast for this year, and they were